Hey everybody, how's it going? So I have a really exciting treat today for you. But before I get to that, I want to show you my shirt, and hopefully I can do this. But here is the back of it. Hopefully that you can see that. Anyways, I was at the Extraordinary Joy Masquerade Ball this weekend, and it is one of my absolute favorite organizations, and I am representing with joy today. Hopefully, you can feel the joy coming off of me. I am representing for joy today because the Masquerade Ball always fills my soul. And I just wanted to give a huge shout out to Amy Meacham and her team with Extraordinary Joy, as usual, throwing an amazing event, inspiring, and just you have to be there to feel it. And I'm gonna throw a link down to their organization in the comments below, and I really check them out because they're amazing. They're doing some pretty remarkable things with researching rare chromosomes disorders, and at the University of Florida right here in Gainesville. So without further ado, let me tell you what we're talking about today. So I have the absolute luxury of spending about 45 minutes with one of my preferred lenders, Valorie Cason with Ameris Bank. So she is a rock star in my opinion because I've been working with her for about 7 years now. And she's just been a rock. She's been consistent. She's good. She provides education for my customers. When she tells them that they're pre-approved, she gets them to closing. And if you've ever bought a house before, you know how vital that lender is and how important they are to the overall success of the transaction. But that's not what we were talking about. So I'm going to get off that. We were talking about current trends, really, with real estate. So you might, if you're in real estate at all right now, you're probably seeing a lot about 3-2-1 buy downs, 2-1 buy downs. You're probably seeing adjustable rate mortgages coming back. And I'm sad to say this, but I've been a realtor for 10 years, and I have not seen interest rates in my entire career over 4.5%. And we're at like 6, almost 7 right now. So this is all new for me. We have never really had to do buy downs. So this is an interesting conversation for me, even as an experienced agent. So it has been a long time since we have had rates where they are right now. And so we're going to talk about the historical aspects of interest rates as well. And we have a ton of great information in there. Hopefully you listen to it all. Hopefully you get something out of it. If you don't have time to watch the whole video, please check us out. I'm going to put a link to Valorie and her contact information so you can call her if you have questions. If you have questions for me, you know I'm here. So without further ado, let's get to this conversation I had just this morning, and I hope you find it interesting. Here we go. Let's do it.
Are you listening? Damn. Yeah.
So, basically the reason I invited you today was, I keep hearing, a lot about different techniques and stuff that, lenders are using to decrease, monthly payments for buyers. And, I was a little unsure about some of these things. So it was for like, a little bit educational. And then also, in addition to that, like being able to share it with other people and kind of explain what some of these things are. So I invited Valorie, who is a lender with Ameris Bank, and she's been one of my go-to experts for, gosh, 5 years, 6 years now?
Maybe even a little longer.
Yeah, something crazy like that. I think I wasn't pregnant with Bailey, so I know that.
Yeah, that's crazy.
So it's been a while. But sometimes you hear a lot of these things and you're just like, what the heck are these people talking about? So that's why I wanted to invite you on. And I had a few questions that I'll ask you, but just know it's like more like a conversation. So we'll just I have some planned questions, but we'll just keep it very informal.
Okay. Sounds perfect.
All right. So first one's pretty easy. What is the current interest rates today?
So kind of, I'd probably say like mid to upper sixes for like a 30-year fixed, looking at low sixes for FHA and maybe a 15-year. Not seeing a whole lot of people doing a 15-year right now. We're seeing definitely more of the 30-year, which is a little interesting, but that's obviously because of where the rates are today.
Mhm.
So it's, obviously depends on credit, loan to value, purchase price, all that kind of stuff is, plays a factor in there. But that's kind of an idea where they're laying.
Okay. Okay. And as compared to, just a few months ago, at the beginning of the year, we were at like 2%. And then a few months ago, we were at 3%. So this is kind of a dramatic increase.
It
And
is.
it's
It is.
hard for people to kind of like jump over that hurdle. Be like, whoa, I could have gotten like 3% a few months ago. How am I
Right.
gonna pay 6 and, 3/4 at this point?
And there's a couple of different things kind of regarding that. Like the first part is, when you're renting, you're basically paying 100% of someone else's mortgage. You're not even paying on your own. So that's one way to think of it, kind of ease that pain a little bit of the rate. But then historically speaking, these rates really aren't that high. I mean, if you look at where we were in, obviously in the 80s, when we were at 18% or so, but, historically speaking, since about 1971, mid sevens is pretty much where our rates have been, or that's kind of the average of the rate. So we're still kind of sitting below average from where we have been before. So it's not a horrible rate. It's just that we kind of got into that, like you talked about, the 3%, 4%, even the 5%. And that's kind of what everybody keeps comparing the rates to today. But historically speaking, they're really not that high.
Yeah. Yeah. So, and that's actually something I had been looking at too. I was like, wow, when you compare like longevity wise, we're really not that high, but I think we're spoiled. Like, I think that's really what has happened. Everybody has
Yeah.
gotten a little spoiled with these lower rates. And who wouldn't be happy with that? Because I mean, who doesn't want a lower payment and less money going to interest, right?
Oh, right. We were doing we were doing mortgage loans at less than what you had your car loan at. So, I mean,
Yeah.
yeah, that was great. But I think also coupled with the fact, and you can probably speak better on this, with the rise in the housing prices. I mean, even though the rates came up and we've seen a little slowdown in the market and we've got a little bit more negotiating ability for, your buyers, I still think, we've had that increase obviously in the home prices as well. So I think that's kind of double hit the borrowers or the buyers, where they're also seeing this increase in housing costs versus, back when the rates were 18% in the 80s, obviously we weren't looking at $400,000 homes most of the time. So I think kind of that's something that has affected everything as well. And you probably know better what that increase has kind of entailed over the last few years, but definitely feel like that kind of double hits them.
Yeah, definitely. I mean, I personally had reached out to you about purchasing another house since we sold ours in July. And even myself being a realtor, I got sticker shock. I was like, whoa, that's what the payment's
Right.
gonna be. So there is an interesting time here with how fast prices have increased over the last couple of years. So I keep telling people when I have this conversation, I'm like, listen, anything to kind of slow down this price increasing
Right.
will be good. And unfortunately, our tool and mechanism for doing that is unfortunately increasing interest rates.
Right.
But it does make sense why people are doing less 15 years, I guess, because getting those payments lower by extending out for 30.
Right.
Probably. Why would you see that as being why?
Yeah, that's exactly what I think is kind of happening. Obviously, you have some people that it doesn't affect them, but overall, when you've got the price increase of the homes, you've got the rate increase, basically taking that amortization out to 30 years versus 15 years helps drastically with the payment. It's kind of when I talk to people, there's so many steps when you do a pre-qualification, kind of off subject, but you're looking at someone's credit and they may say, oh, I want to put 10% down. Maybe they're right there at that line where their debt ratio is going to make it or break it depending on how the insurance comes in or how they, what house they pick and what the taxes are on that house. But there's a different way you can look at people's pre-qual too, where maybe they have a credit card that they're paying $200 a month on, and it's 20 something percent interest, and they really want to qualify for this house. And then we can look at, hey, how can that 10% down, can we change it to 5% down, pay off all your credit card debt? Maybe they can qualify that way. I mean, it's kind of not specific, or it's specific to each individual what you do, which just like you were talking about the buy downs, it's the same. It's kind of no one size fits all for everybody. It's really trying to get to know the customer, getting to know what they want, getting to know is this going to be their long-term house? Is this a house for 2 years? Are they just here in medical school, or are they just here as a student? There's so many questions to ask, and that's where, you talk about me being one of your go-to lenders, which I so appreciate. But it's really important always to me to really have that local expertise, your local expertise as a realtor, my local expertise, or some other lender that's a local lender that really understands this market and really talks to the customer and really gets to know them and knows their goal. What is that end goal for them? That's important. And that all kind of plays into this whole interest rate buy down that we were kind of mentioned earlier.
Yeah, and speaking of the interest rate buy down, so one of the things that I keep seeing all the time now is the advertising on listings, seller willing to contribute to a 2-to-1 buy down or a 3-to-1 buy down. So I mean, this is new for us because we haven't had to buy down interest rates for so long.
Right.
And I honestly, it's funny because it's crazy to think about this. So I've been a realtor for 10 years now. So April was my 10-year anniversary of being a realtor. And I've never had interest rates above 4.5% in the last 10 years that I've been a realtor. So for me, this is a 10-year expert here,
right.
With all my experience. I've never had to deal with this. So people are talking about 3-2-1 buy downs, 2-to-1s, arms, like all these things. And, there's a lot of newer agents and even some of us seasoned agents that we haven't had to deal with this. So how are people using this to kind of reduce their payments, and what is this? Like, what are these, and when would you use a 2-to-1 versus an arm? And, I know that's a lot of questions.
No. So there's a couple of different things. So there's what we call like a permanent buy down. And then there's like the 3-2-1 buy down. Kind of somewhat the same, somewhat different. So you have a permanent buy down is basically when we would call a borrower and we would quote a rate, and they would say, what do I have to pay to get that rate lower? So what points do I have to pay? And we would quote that. They basically buy the rate down, which I'm sure you've always, heard that. So we buy the rate, it gets added to their closing costs, and then that rate is changed over the life of the loan. So whether it's a 15, 30, whatever the life of that loan is, that's just a permanent buy down. So we've done those for a while. And honestly, like you said, rates have been so low for the last 10 years or so that basically nobody really did the buy downs. It was rare that you had somebody that did that.
I think the only time we really saw them was when they were really close on those debt to income and they needed to. So I think maybe it's really the only time I saw that, when they've had maybe not the greatest credit, they need to buy it down a little,
tweak the payment a little bit, or they had like extra seller concessions, then we could look at buying it down, things like that. So then comes this, 3-2-1, which is kind of newer for me, to be honest, as well. So that's basically, usually it's seller paid or it's lender paid. So the buyer does not pay for that. So like you're talking about, you can actually see it in the ads where they'll say seller will contribute. Well, really, they can use that seller contribution for anything. It can go towards the 3-2-1 buy down. It can go towards just their closing costs, just can't obviously go towards their down payment. And we still have to make sure that we're sticking with the Fannie and Freddie guidelines on what each program specific. I know we've talked about this before, depending on how much they're putting down, depending on what program they are, there's certain percentages that a seller can contribute. So it does still have to lie within those percentages. They can't give more than that. But really it's hard to say, because you have the 3-2-1 buy down, which is basically on the first year, the rate's going to be 3% lower. On the second year, the rate's going to be 2% lower. On the year one, then it's going to be 1% lower than that locked in rate. And then after that, it's going to revert to the normal payment, or the normal rate, excuse me. So, it's a great, great tool to have in your toolbox for sure. But it's not a one size fits all again, because, depending on where things are moving, right now, I would love to say I had a crystal ball and I know what rates are going to do. But I don't think anybody really does. Like, you can just literally Google it and you can find, 50 different articles that pop up and talk about rates are going to go up, rates are going to go down. This is what's going to happen. Yeah. Ultimately speaking, we're at the mercy of the Fed, inflation, all of these different things that are contributing factors to this. So we may see rates lower, which is kind of where I feel we're going to be heading in probably 12 to 18 months, a little bit lower, nothing drastic, but I would say maybe hopefully in the fives is what my, my hope and thoughts would be. If that's the case, then, when you do these 3-2-1 buy downs, they are costly for, a
Yeah.
seller. So it really is specific on each person, what is going to be best for them. And again, it's having that conversation, because I know we're probably going to see another, period of refinances, where everybody's purchased in the sevens, maybe the high sixes, maybe they want to add a pool, maybe they want to pay off debt. I mean, most people don't get a 30-year mortgage and stick with it and pay it for 30 years and then they're done. Most of the time they're refinancing it for some reason. So the 3-2-1 is, 3% for the first year, 2% less for the second year, 1%. It's the same with the 2-1, 2% less for the first year, 1% less for the second year, and then basically reverts to the original locked in date after that. Also, it's kind of good to note that they do have to qualify based on the actual locked in rate. So, some people hear that and they think, oh, I have this customer that's got a really high debt ratio, let's get them that, but it doesn't work that way. We have to qualify them based on that higher. But for the right people, this is great, having a payment that changes by maybe $200 or $300 a month for someone that maybe they qualify, but they are, very fixed on knowing what they feel comfortable with their payment. Maybe they're in school and graduating in 2 years, so that payment factor isn't going to be as big of a deal once they have their, higher paying full-time job, whatever the case may be. So there are instances where it's really good. It's just not, again, a one size fits all. So it's that conversation with the customer, finding out, is the one-time permanent buy down of the rate best? Do we want to look at this 3-2-1 buy down? Is that going to work better for them, for the payment impact, monthly? So it's just having those conversations, kind of like everything else.
Yeah, that makes total sense. And, I'm actually glad you mentioned that, because I think back in, when right before the crash happened, a lot of people were getting into mortgages that ballooned, and when they ballooned, you couldn't afford them.
Correct.
So, and that's what caused a lot of the defaults. So in my head, I'm thinking back here, oh man, we're going to be back in the same situation where people got these buy downs and then it goes back up to where it should be and they can't afford the payment now. But it was good that you mentioned that they actually have to qualify based on the higher interest rate.
Right.
So it wasn't like they're qualifying on the lower price, which is I think what they were doing back in 05, 04. And that's what led to a lot of the problems that we did have. So I'm glad that you mentioned that, because I think nobody wants to see a crash like we have been dealing with for the last.
No, I know I don't. But yeah, you're exactly right.
From.
Yeah, it just really does depend on, the borrower, and getting to know, some people are payment sensitive. Some people are cash to close sensitive, so when you really work with these applications, paper is one thing, it's great, it tells a story, but really talking to your customer and finding out what their plan is, what are their goals, what are they where are they looking to be in 5 years? That will help them determine, in the same way with the ARM loan, it's the same exact thing. Do they feel like they're moving into this house for 30 years? This is where they're going to be for their entire life. It really just depends on each customer, separately. So I guess that's what I always hammer home with everybody, is there's just not that, clear answer, unfortunately, on anything we do, as you know, too.
It's true. Everything is so individualized, which is like why when I first meet with people, when they say, hey, I want to buy a house, my first thing is like, hey, let's sit down and have a conversation. And I think that's, kind of how you operate too, which is, I think where, knowing your customer and their needs, it actually helps us guide them and get them into the right place to financing terms, or right house, or right situation.
Oh, absolutely.
Yeah.
When we work as a team, and that's what's really, really important. And I know you and I have actually had people on a 3-way call before, several times, sitting down, talking to them about what they're wanting. And I think that's really important, because you have to work together like that to get the best, the best product at the end for them and for all of us, really.
Absolutely. So, with these buy downs, I know that, there's and to people who don't understand this, you can't just spout out like interest rates and payments. So there's a lot of like federal regulations that go into this.
Right.
But with that being said, without me getting you into trouble with the financial powers that be, what is a typical like buy down costing? Like how are those numbers calculated? Like if I'm wanting to buy a house, like what could I expect to spend on something like that?
So it's very pricey. So the seller is basically paying the difference in the payment over the course of that 3 years, or over the course of the 2 years, or the course of the 1 year, just depending on what you do. So, if you have a payment that's, let's say, $1,500, I'm just using, round figures. But if you have a payment that's, let's say, $1,500, and then we take it down to $1,000, that's $500 difference, let's say, a month, just, throwing something out there. So basically what they're going to do is they're going to take those funds, whatever that difference in the price or the payment is, and it's going to be multiplied over the 3 years, 2 years, 1 year. And it basically is getting kind of what I'd say banked, in an account. So it's truly the cost of the difference in the actual payment. So it's a little bit different than that permanent buy down, which the permanent buy down, it's, obviously it's going to be different every single day. But we look that up on our pricing sheet and we say basically, hey, here's your rate today. We call it at par, which basically means at no cost to the borrower. Or here's your rate if you want to pay, 3/8, if you want to pay, a quarter point, like whatever they want to pay, or here's your pricing without that. So it's costly. I mean, I just quoted somebody one the other day and it was around $8,000. It was a higher loan amount, but it's definitely pricey. So again, you've got to also make sure that you're staying within those guidelines on each product, and just to see basically, what the seller can contribute. So you can't go over that either.
Okay. So that also makes sense why it would only, it doesn't really benefit the buyer if they're making up it's going to be the same amount either way. So makes sense why you're seeing a lot of seller advertising on this then.
Yeah. And it's kind of sometimes too, I know you've probably seen the things that people have been sharing on Facebook, not that they're necessarily completely accurate dollar figure wise, but I see what they're trying to do. And some of it does make sense where when you're looking at, the purchase price of the home, and now, you have that little bit of flexibility that we weren't seeing seller credits, a few months ago. We weren't seeing price reductions in houses, a few months ago. So now buyers have a little bit more leeway than they did. So you see all these ads that everybody's posting on Facebook that's like, hey, the house was 400,000. Now you might be able to get it for 350. And then if you have a seller credit, you can get that down, your cost to close down even a little bit more. So they're looking at kind of different ways, like, hey, is it better to negotiate the price of the house down, to 310 versus 350, or 310 versus 320, or get a $10,000 seller credit. So, and again, that really is that conversation, like when you and I, when we work on a pre-qual together, and I think that's where the teamwork comes in so well. Like I was saying, some buyers are payment sensitive, some buyers are closing cost sensitive. It really is different for every single person. So sitting down and having that discussion with them before you make your offer is great. And I know we always work like that, where I'll call and I'll talk to you and I'll say, hey, this is the borrower's giving me the okay to talk to you, and this is what we feel like we're at. And that's really, really important, because this may not be the best use of those funds for some people. For some, it may be trying to get a price reduction on the house. For some, this may be the best. So it's just having that, initial conversation about that is really important.
Yeah, absolutely. So, I think, you nailed it there with just saying, like, having people who just have the conversations and understand what the buyer is needing. So one of the questions that I, and you are 100% right about, just that I know what ad you're talking about. And I was like, ooh, y'all, this is disclosure like nightmare right here. Y'all not need to be sharing this. What are y'all doing? Like, if there was one thing that stuck out in my head when I got my real estate license, it was not to do that. So they're sharing the payment information without interest disclosures and terms, and that's a big no-no. That'll get you in a lot of trouble.
Yeah, I don't ever like nope.
Yeah, so I always, especially when it comes to any financing stuff, I'm like running this by my broker or my lender. Like, hey, is this compliant before I share anything that has
right?
On it?
It's scary, and none of us want to get in trouble. That's for sure.
That's the truth. We do not want the DVPR to come knocking on our door. I got a funny story I have to tell you about that. I actually did get a call from DVPR about something the other day.
Oh no!
I was like, DVPR. Well, I guess I'll go ahead and say it since I mentioned it. But so I was like, you're an investigator? Like, my heart just like. Ugh.
I would too.
So as you know, we've been doing some investing and buying flip houses. there's this house that came up on the MLS, and we wanted to go see it because it was a good deal, you know. It made sense for us to possibly purchase. So we called the information on the MLS, and he's like, just go knock on the door. They're expecting people to come by. And I'm like, oh, okay. I mean, this has happened before, so it wasn't completely out of the norm.
Right.
So I was like, okay, so you're gonna tell them we're coming? They'll know. I'm like, okay. So I hesitantly like went and knocked on the door, and the owner answered, and they're like, what are you talking about? We're not selling our house. Like, get out of here.
No.
So I'm like, oh, okay. So then after a conversation with her, she was a daughter, and she was like power of attorney for her mother, and someone had gotten the mother to sign some documents to sell the house, but it wasn't legal because she technically had power of attorney. And so anyways, I had given her my business card. I'm like, listen, if I can help in any way, let me know. I would say I would reach out to this person, that person, and told her who to reach out to. So anyways, I got that phone call and my heart sank.
Yeah.
Like, oh Lord, what did I do? And it turned out just to be related to that. So anyways, it was just a funny story, but I think she got it solved, hopefully. I just told her the basics, and I'm like, I don't want you calling me ever again. I'm like, I'm never giving my card out to be friendly again.
Right.
But yeah,
That's right. This is a new phone. Who are you asking for?
I'm like, no. Anyways, sorry, that was just totally random, out of the blue, not an important conversation. So, anyways, so I did have, and I actually already talked to you about this customer. I did have a question that came up yesterday, and this is a question I get a lot, and I thought actually that when the market's shifting, I wouldn't get it as much, but it's interesting because this buyer seller is actually in a different situation where we are in a shifting market, and houses are surprisingly now taking longer to sell. So before, we could put a house on the market and I would know, like, it didn't matter what it was or how it looked or anything. I knew I was going to get like 10 offers on that in the first couple of days, you know, and it was going to be sold in the weekend.
Right.
But now we're in this situation where people who need to sell first, then buy, are kind of back where they were, several years ago, where we don't really know how long it's going to take for their house to sell. We're in a transitioning market. We're kind of in this limbo stage where the market has slowed down, but we're still short on inventory. But buyers are kind of, I think, waiting to see what happens. The people who don't have to buy right now are not buying. Right. The only people that you're really seeing right now are the people who have to buy. So, so we're in this situation where we have a seller who wants to sell. They have their house listed for sale. They don't have a contract, but they now have a house that they really like here in Gainesville they want to buy. But majority of the equity for the purchase is going to be coming from the sale of their home. So they have enough money to buy. I think they have like 10% down. Again, this is where specific situations come into play, but they have like 10% down right now where they could buy the house, but they don't necessarily want to keep the payment on that 10% loan, 10% down payment. They want to be able to have the 50% that they're going to have when they actually sell their house, but they don't want to lose out on the house they have. So I know that was a long story, and hopefully it made sense, but what are the options for these people? Like, I remember like a few years ago, there were some options for this situation.
Yeah, so the main thing that we do most of the time is like a bridge loan, which is going to be a short-term type loan. So usually that's done over up to 12 months. So obviously you have plenty of time to get the home usually sold, even in this market. So
yeah, even I feel good in 12 months. Yeah. See.
So you've got basically like 12 months. It's going to be an interest-only payment over those 12 months. And then with that being said, they can take up to, I think it's 80% loan to value, just depending. So in that case, they can go ahead and they're putting all of that money down if they want to. Now, again, that goes back to kind of the qualification where they have to qualify with both of those payments. That's kind of one side of it. The second side is, let's say you have somebody who has the money to put down, like you're talking about 20% and whatever they're going to put down. They don't need the equity necessarily in their current home. They're okay to buy right now. Or sometimes you have people that say, happens a lot with property that maybe has been in the family for a while. I've actually dealt with it a couple times where they truly don't know what they're going to do with it. Like, maybe it's in over on the lake and they're buying a house here in Gainesville, but they're saying, oh, I don't know if I want to sell. I don't know if I want to rent. I don't know if I want to keep it as a lake house, but I know I want to buy this primary residence in Gainesville. So we'll go ahead and do the primary residence loan. And then maybe in 3 or 4 months, they call and they say, hey, I've decided to sell my house. I'm going to net, 250,000 and I
Yeah.
have this $350,000 loan with you guys. What do I do at this point? So that's when we kind of start talking about like a payment recast is what it's called.
Yes.
And there's a couple of different ways to do the recast, or sometimes people just put the money down. They don't care if it changes the payment or not.
Yeah.
That's some people. Some people want to put the money down and they want to actually re-amortize their payment based on the lower amount. If that's the case, then there's paperwork that we kind of do on our end. There is usually a charge for it. I think it's around $300 when they're actually not to make just a principal reduction, but to do the actual principal reduction and the recast. So you're changing kind of the paperwork, you're changing the payment for them. Then we can do, the recast as well. We send it in, it gets approved, and then we basically update everything. So kind of a couple of different ways you can handle that, just again, depending on the client's exact needs.
Yeah. Okay. Yeah. I couldn't remember what it was called. I'm like, I'm pretty sure that this is something that we can do.
Yep. Yeah.
Maybe I don't remember. But okay. Well, that makes sense. So, I think that's going to be coming up a lot more, coming soon because and before it was, I do not want to talk to you, Siri. Anyways, before it was, hey, we're not gonna be able to find a house. And now we're kind of like in a situation where, hey, I don't know how long it's gonna take to sell my house. Even though I'm still doing, I'm still like before I was like, hey, you need to be ready to move like in 30 days
Yeah.
or
Right.
your house is selling, it's gonna sell.
Right.
Whereas now I'm preparing everybody for, typically a 90-day marketing plan, which is kind of where I was at before this crazy, whatever this last 2 years was that we've been in,
Yeah.
like COVID market thing, whatever. I don't know what you call this. I'm sure they're going to come up with some term for
I'm
it
sure.
in the near future. Anyways, so I do want to have one other question for you. Is there anything that your customers have been asking you a lot lately that you think would be helpful to our conversation?
They definitely want us to have the crystal ball that I don't have and know exactly where rates are wanting to go.
Me too.
Yeah. And so that's definitely been an interesting conversation. And then a lot of times, like you always refer people back to me, they'll ask me questions that I refer back to you guys because I'm not the expert on the housing market as far as where pricing is going and where pricing has been and is this a good price for this house. So I think, like I know I keep hammering on it, but that working together is what's so important for me because I can't tell you how many times I do have someone call that maybe was working with, ABC realtor that didn't give them necessarily all the information they should have. Or I have somebody call, a realtor call and say, hey, I've shown these people 12 houses, they're in looking for 500,000. I just sent them your name to do the pre-qual. And then, they qualify for like 200,000. And obviously then nobody's happy. So, really more than anything, it's probably been interest rates. And I just keep hammering in that, historically speaking, these rates are not crazy high. I mean, they truly aren't. And you look at the majority of probably all of everyone has probably quite a bit of credit card debt. And people don't blink an eye paying 18 to 20% on their credit cards, but everybody starts really freaking out, for lack of a better way of saying it, when our rates hit 6-7%. So that's kind of something I kind of tell people sometimes. And then people that are renting, you're paying 100% of somebody else's mortgage, right now. So is 6.5, 6.75, even 7%, is that really horrible to pay? It's like you said earlier, I think we were in this market where we kind of had these historically low, probably too low rates from where they really should have been. And everybody kind of got spoiled. And so I still literally have people call that say, hey, I'm approved with, an online lender. And they told me I'm at 4%. Can you match that? And I just, no. And number one, and you're probably not at 4%. You're probably not really there. And then you just have to have that conversation with them and prepare them for where they really are. Because most of the time they don't get loan estimates. They don't look at what they're paying, in points.
Yep.
Or honestly, sometimes there's some not great people out there that just truly lie,
Yeah.
and it's not correct. So I think just making sure that everybody understands where the market is right now, where housing is. When I do a pre-call, you were talking about, you've been doing this for a long time. Same here. We see these rates, and I normally would quote a rate and it would kind of stay the same throughout the day. It's not always like that now. Sometimes they can change 2 or 3 times in the day due to the volatility in the market.
Yeah.
So I always tell people, like, hey, if I call you about the rate, like, you've got to get back with me, because if the rate was that at 11 a.m., it doesn't mean it's going to be that at 4 p.m. So having that conversation with them and having them understand that those rates can change, and we need to lock whenever they really want to lock. Like, if the payment is doable for them, lock it in, is what I always say, because none of us, the market is right all the time. I'm right some of the time. Larry Bear talks about that. It's not always going to be correct. So it's just kind of taking your best guess and where you feel comfortable, and and running with it, unfortunately. But they definitely want to know where the rates are going, and I just don't have the crystal ball to tell them.
Yeah.
If I do, I'm going to be a millionaire, and I'm going to fly off to like island.
Right? Well,
I know, but I never play the lottery, so I got to do that to win.
So I will say that one of the conversations I do say, or one of the things I tell people, is I think that in 6 to 12 months time, as long as the Fed doesn't, and I think the Fed being a rock, being stable, is going to help consumer confidence. Like, their yo-yoing isn't helping consumer confidence.
100%. If they continue on their plan of raising the interest rates a little bit, I know that again, really people don't like to hear that, but if they continue that plan, inflation begins to come down, the 10-year treasury, I mean, everything is intertwined. So, and I know the election is going to play a part in it. We don't know what, but that's going to play a part in it. So there's all these crazy aspects to it. But again, like you said, the yo-yoing is definitely not a good thing. We definitely need that standstill. And just to reach out to your pre-quals, I try to reach out weekly if I can, and say, hey, here's where rates are, because especially like a month ago, we would pre-qual somebody, on a Friday, and by next Friday, they may not qualify for that amount, especially if we talked about that debt ratio, if they're right there at that line. And that's the last thing we want, is the realtors working towards a $400,000 house when, oh, oops, now it's the next Friday, they're under contract and they don't qualify.
Exactly. So, yeah. So I think in like 6 to 12 months time, I think with stability, I think people will start to recognize this as our new normal. And I think people will be getting more confident in purchasing and then selling when they, if they're on the fence of selling right now, because they do have a lower interest rate. So I think that's where we'll be heading. That's my one prediction that I'm making.
Right.
Which I think is founded in some logic. Whereas the Fed is not. I mean, I know. Doing.
That's what's hard, is everybody keeps asking you, and I'm just like I don't really know. I don't know. I mean, your guess is as good as mine sometimes.
Yeah, I know. So, well, I think that was pretty much everything that I had. I really appreciate you coming and talking with me and jibber-jabbing for the last 40 or so minutes. That went really fast, by the way.
Yeah, it really did. I thought it'd been like 10 minutes. So someone's going to watch this and be like, she needs to stop talking.
You're like, well, y'all shut up, Anyways, this is Valorie Cason. Again, she's a lender with Ameris Bank. You guys know me. I'm Kristen Thompson. I'm a realtor with Better Homes and Garden. And thank you guys for listening. I'm going to put Valerie's contact information in the comments. If you have any questions, you can reach out to her, or, as always, me as well. We're here. I feel like we're experts. Even though I said, I don't know, I've never dealt with it, but I feel like we're the experts, at this.
We can call ourselves experts. That's fine.
Whatever. I'll call you the expert. You can call me the expert.
There you go. That works.
Anyway, so I feel like we're experts in our field. That's why I work with people like Valorie, is because she has proven herself to me time and time again. I always tell people when I give them my lender list, it's very short, and it's very short for a reason. And it's because everybody has earned their way onto that list. And I really appreciate you know, the consistency that people like Valorie offer. And that's why I trust them with my customers, because they make me look good. So,
Thank you.
so, anyways, I think I'm going to run out of time if I don't say bye, but all right. Thank you, Valorie. I really
Thank
appreciate it.
you. Have a great one.
You too. Bye.